Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. Hope you had a great weekend. It is February 12th of 2024. We have a decent amount of items to go through this week. It was a fairly quiet week last week as it relates to 90% of the market. About the 5% of the market related to semiconductors and technology, those continue to rip higher. And we continue to believe that area, that pocket of the market remains extremely expensive. So we are definitely not chasing in that area of the market. The other area that was noisy, call it the other 5% or so that was creating noise was, of course, internationally, and those were Chinese stocks, Chinese markets. Of all the markets that are in a structural bull market right now, China is not one of them. China has and remains in a multi-year bear market, and we're going to go through that today. And we definitely have seen signs that the panic stage has set in as it relates to Chinese stocks, and in many cases reminds us a lot of the US market in March of 2009. So we'll go through what that means, not just for the Chinese market, but also for the US market and the types of sectors and stocks that may go up if we see a recovery overseas in China. So let's go ahead and get started. I'm going to go ahead and share my screen like I do every single week here. And the title of this week's presentation is, Are there any cheap stocks? And the reason why we say that is the S&P 500 right now trades at a 21 times multiple. And that's historically quite expensive. But what we're also seeing is this huge divergence between the average stock and your Magnificent Seven stock, which is having a disproportionate impact as it relates to the S&P 500 movement, how you actually see that index move on a daily basis, and also the valuation. So we're going to go through all of that this week. First, what does an overbought stock market mean? Right? Stocks are overbought right now from a technical perspective. What does that mean short and long term? Number two, are Chinese stocks so bad that they're good? You can see all the negative headlines here to the right. We've definitely hit that panic stage as it relates to the Chinese market. And lastly, are there any warning signs emanating from the credit markets? For those of you who have been following us for a few years, we really do pay attention to the credit markets. They're our North Star as it relates to any potential financial crises that might be taking place. And certainly we've had some headlines as it relates to commercial real estate. So we want to make sure that the actual metrics that we look at are back in the headlines or not. Real quick here, as you can see, stocks are somewhat overbought here. And that doesn't mean we're going into a bear market. That's not what we're saying. But short term, they're a little bit overbought. And so when we look at stocks here, this is the S&P 500 in a channel. We're sort of at the high end of this channel, and we can expect a pullback. That doesn't mean that this bull run is over. In fact, we do not believe it is over, but you can get pullbacks, and they can be painful over the short term. So in summary, stocks, yes, they're stretched from their 200-day moving average, that they're top end of the range. But long term, it's important to remember that bull markets spend most of their time in an overbought condition. I can't tell you how many investors I've talked to that sat out for most of the 2010 to 2020 bull market. Why? Because stocks were overbought, or we were going to go back to the 2008 lows, et cetera, et cetera. And it was a structural bull market. The same happened in the 90s. The same happened in the mid 2000s. These markets, when they're in a bull mode, tend to stay overbought longer than people expect. And so that is something we want to pay attention to. Real short term here, the number of stocks above the 50-day moving average has started to fall while the headline index continues to move up. That can be an early sign that we're reaching a short-term top as it relates to stocks and that we need to take a breather. We think that would be healthy. You don't want to see stocks go up every day. Even though all of us would like to see that, longer term, it's healthier if stocks take pauses, right? Same with a marathon runner. If you are in a marathon and you try to run fast the entire time, you're just going to collapse at one point. And so we want to make sure that the advances that we're seeing in the stock market are measured and that they're being those returns are widely distributed and not just being pulled up by 7 or 8 stocks. As it relates to outflows and why we think that the bull market still has a fairly strong foundation is that there's 2 components that remain that lead to viable long-term bull runs. And that is skepticism. You just have to go onto Twitter or X or whatever you want to call it and take a look at what the overarching commentary there is. Or you can look at the actual hard numbers and what people are doing with their money, which is staying in cash. And when we look at this recent bull run, equities remain in outflow mode, right? Outflows have continued to be negative, while institutional retail money market funds have been the recipient of over $1.4 trillion of inflows, while equities have had $21 billion of outflows. Bonds have been recipients of, well, just under $200 billion of inflows. So what are people doing with their money? Forget words, pay attention to action. They're playing defense, even though the market has gone up. And at some point, the market is going to pull people back in. And when this money gets pulled back in, you should see a more widely distributed return framework where the other sectors that have not been participating start to play catch up to those Magnificent Seven. And that's why we're not so hyper focused on the Magnificent Seven. Yes, we're not participating in those returns, but that's okay because returns are fleeting. We learned that in 2022. So we want to be disciplined. We want to pay attention to price and we want to pay attention to the fundamentals, right? So that's really, really important. From a symptomatic standpoint, consumer and transport stocks continue to break out. It's really hard to see where a recession is going to come along, where you're seeing consumer discretionary stocks and transport stocks breaking out relative to their defensive peers, whether that's consumer staples or utilities. On the verge of recession, you tend to get breakdowns in these relationships where utilities start to take the lead, consumer staples start to take the lead. These are areas of the market that have less earning sensitivity to recessions, so those stocks tend to do better than their more sensitive peers, such as the transports and consumer discretionary stocks. So bottom line here is these are good symptoms. We don't want to fight them. There's good news, there's bad news, and then there is what the price does, right? We pay attention to what the price does, and we let that be our guiding North Star. Valuations, right? So this is the hard one, right? This is where you have to really sort of dance around the minefield because the S&P 500 at 20 to 21 times earnings is historically expensive, right? You would look at the historical average of around 15 to 16 times and be like, hey, I feel pretty good about the market. It's not super cheap. It's not super expensive, but I can find pockets of value in and out. When you're getting above 20 times, I mean, you're talking that only a few other times in history where the S&P 500 is consistently traded above 20 times earnings. And those long-term returns aren't attractive. Now, what makes this a weird time period is a lot of that valuation, that 21 times, is the result of what's happening with the Magnificent Seven. The Apples, the Teslas, the Nvidias, the Googles, the Amazons, etc. Meta, those stocks, because they're so large, each of those stocks representing north of $1 trillion in market cap, I believe as a group close to 10 trillion in market cap, they're pulling the valuations upward for the S&P 500. So in statistics, it's those outliers that are dragging and having a disproportionate impact on the mean and the median PE. The average stock, on the other hand, is actually quite cheap. When you strip out the impact of the Magnificent Seven, you actually get a market that's trading in the mid-teens. So what we wanted to show investors this week is where we focused on, right? We're not focused on the Apples of the world, right? Where you still see the relative strength despite the new goggles that came out and everything else and the crazy memes around those goggles. the relative strength of Apple continues to break down. This stock has done nothing for the better part of 2 years. And when we look at forward returns as it relates to PE, when you start to buy a group of stocks that are north of 20 times earnings, you have the lowest average 12-month forward return of any other PE decile, right? So when we look at where we focused on right now as a group, valuation-wise, forget the sectors, forget the stocks, just valuation-wise, where are our portfolios constructed and concentrated on? They're anywhere in the sub 10 times to the 12 to 14 times category. You can look across most of the stocks there. They're trading somewhere between 8 and 14 times earnings. And why is that? Well, we like the businesses. We think that they're cheap. And from a forward return perspective, that's where we historically see the most attractive rates of return. So price does matter. Now, over the very short term, over the next couple of weeks, it may not matter. But long term, it does matter. And that's why the Cathie Woods of the world can be flash in the pans, but over long term, Buffett caught up and significantly overtook her. It's the same thing. So you have to have long-term discipline. That was one of our big lessons from 2022. Earnings-wise, things look great. Of the 302 companies that have reported so far, 60% of the S&P 500, 81% of those companies are beating estimates. And remember, that was after a bull run in Q4. So revisions did get taken up as a result of that. The economy has been better than expected. So we're not necessarily dealing with a situation where companies are beating lowered estimates. Estimates have come up and companies are still beating. And, you know, on the top line, on the sales side, 66% are beating estimates, which again, historically is very attractive. And that's where we want to see companies coming in at. There is an area of the market that's not doing so hot, and that, of course, is China, right? Over the last couple of years, the Chinese stock market has gone down 50%. To put this into perspective, the peak to trough experience of the S&P 500 from 2007, November of 07 to March of 09 was down 54%. So we're talking global financial crisis era drawdowns. So this has been very, very significant. And what you've seen over the last couple of weeks is sheer panic in China, where close to 80% of stocks are now trading at 52-week lows. In addition to that, you have the small cap indices in China that were down 10% in one day last week. So you're just seeing sheer panic. And that is actually where you start to get closer to these March 2009 types of levels where it might make sense. And we started to do that last week. Buy some of the really, really high quality businesses within that market that is in turmoil, right? You have companies like Alibaba or JD that on a forward PE basis are trading 8 to 9 times earnings. We're fairly confident those are real businesses. They're not going away. They generate tons in free cash flow. The controversial side, of course, is China, right? And I know a lot of people have political emotions as it relates to the Chinese and US relationship. And we address that at the client level. So if you see a couple of those stocks in your accounts, please feel free to give us or your advisor a call. We'd be happy to make adjustments on that. But our job at the end of the day is to find cheap merchandise on a global basis and let that be our guiding North Star and hopefully make money for clients. And that's where we see some of the cheapest merchandise on the planet right now. While lots of stock markets are overbought, we have a market here that is at a 2-year low, down 50%, with many blue chip types of stocks with very rock solid balance sheets that are trading single digit PEs, very similar to the US setup in March of 09. We want to pay attention to that. So when we look at areas that could possibly react positively to a China bottom, we looked at an earnings sensitivity chart here. So if Europe, China recovers, what are the sectors that tend to do well? Obviously, China stocks, that goes without saying, but materials, energy, and industrials, those economically sensitive sectors in the West that would benefit from higher volumes coming from China, because China is a very raw material intensive type of economy. So clearly energy and materials in particular, we right in the bullseye there. One of the 4 areas that we are overweight in the portfolios right now. Credit markets, again, if something emanating from China or the commercial real estate market was of material significance to the wider market, or we were expecting that contagion to be widespread, you would see it starting to bubble up in the credit markets, and you just have not seen it. Financials, discretionary, energy, all probing 52-week lows as it relates to their credit risk premiums. Upward is bad in this case. Down is good because that means there's less implied credit risk. We want to see that. The fact that financials are near 52-week lows despite the noise from commercial real estate, again, I think that's very, very positive. The canaries, in other words, they're continuing to chirp. They're not dropping dead there in the coal mine. So overall, we want to embrace strength, but we don't want to embrace those areas of the market that are at nosebleed levels, right? We don't want to chase with the rest of the crowd. We want to be careful. 3 things to remember: bull markets really do spend most of their time in an overbought condition. So don't get too panicky if you see some pullbacks. That's natural. We are overbought. At the same time, if we are in a longer term bull market, those pullbacks tend to be a little bit shallower. Don't chase the high valuations. Price does matter. And lastly, those credit markets remain rock solid. So that's what we got for you this week. 888-543-3776. Thank you for your business, your time, and your friendship. And if you have any questions, please feel free to reach out. Thank you again. Have a great week.